Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Bill Bailey, analyst with Nasdaq IR Intelligence, for an update on technicals and who is doing the buying in the market. Bill, it's great to see you as always. Welcome back to Trade Talks.
Thanks for having me back.
And Bill, let's take a look at who has been participating in the market since we last met.
Yes, definitely. So last time we talked, we had a pretty good conversation of the long-only community and their effectiveness participating in a rally. They really pushed stocks higher, all through 2020 and in the early part of 2021. But the interesting thing is retail has been there pretty much every step of the way in lockstep with them. So recent trading, it's hard not to think of what's going on in the markets finding some stability just after, a little spat of turmoil and some turbulence. Even in this morning, we see some stability going on in stocks. And a lot of this is related to institutional buying. And so we look at the first week of March when we kind of had that initial correction in the Nasdaq. We saw retail for once actually not buying. So we try to think who is actually doing the heavy lifting there. It was institutional money doing the heavy lifting. And that matters because we know for any rally to be sustainable or have any for stocks to have a chance at sustaining a higher trading range, that money really needs to be active and deployed in the markets. And so we kind of saw that fallback and then some rebounding, and then that was pretty much institutional money doing the heavy lifting there.
And Bill, when we take a look at the S&P 500 from a technical perspective, it certainly has had an interesting couple of weeks as well.
Yes, definitely. And a lot of that coincides with that sell-off that we were talking about. So we had 3,800 to 3,850 in early February that we just blew past. That was a tough resistance level. And so a lot of that buying there was good volume, strong institutional participation. And then when we came back to that level, we would have expected that to hold up as support. It was a very scary time, for the markets briefly. The Nasdaq went under a correction, quote unquote. Everyone's, hyper-focused on the 10-year yield climbing at this time. But really what we saw is we had one day where it broke support there, but it really, by a technician standards, it was never able to confirm that move lower. So a lot of that was thankfully and credited to the institutional buying doing the heavy lifting. So they really were the ones who bought the dip there. And they pushed the stock back up above that level. So last week, even though we slid lower, I think we found some stability and some strong footing, and that led into today's trading as well. To the upside, though, we have very tough resistance in the S&P 500 between 3950 and 4,000, and we're in that tight trading channel right now. That's going to be tough to see what happens when we get back to those levels. We tested it early last week, and weren't able to get past it, and I think that's kind of our next test.
And Bill, to wrap up here, what are you focused on moving forward?
So that tight trading range is really interesting. And like always, I'm very interested to see what the breadth looks like when we get to those levels. So seeing 90% breadth on the most recent uptick is very great to see. But then last week when we tested those levels, weren't able to make it there, seeing like 60, 50, 40% breadth. So that makes a lot of sense. That's really ultimately what matters. But I'm human like everyone else, and the 10-year treasury yield is like just taking control of the market focus right now. But I like to think of it, there's a silver lining there, because the 10-year yield climbing isn't really surprising, in my opinion. I think that rally has been in an uptrend since late summer last year, since the Fed was dovish and they announced their inflation targeting measures. The TLT treasury yield is just a direct benefit of that. So we're seeing new lows made there, and that's a defensive trade. So if we're not seeing strong bidding there, there's really no reason to think that people are running for the exits yet in stocks until that starts to get a strong bid. And right now, bonds just aren't the place to be. And a lot of that has to do with everyone's concern over inflation. Fed seems to think that the inflation isn't there. The rest of the marketplace is also very focused on assuming that inflation exists, but just in different scores. So if we actually achieve those inflation targets, the treasury yield, it should be climbing. And bonds are not the place to be, and we're not seeing any defensive trades there yet.
All right, Bill, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.